People think I made my fortune through activist investing and hostile takeovers. They're partially right. But what most people don't understand is the foundation of my entire investment philosophy. It's not about finding the next hot tech stock. It's not about timing the market. It's about one simple principle that has compounded my wealth for decades: cash flow. And the most reliable, predictable, and powerful form of cash flow in the stock market comes from dividends. I'm Bill Ackman. I manage Pershing Square Capital, a hedge fund with billions under management. I've made some of the biggest activist bets in Wall Street history. I've fought CEOs, restructured companies, and generated returns that most investors only dream about. And through all of that, through every investment thesis I've ever written, through every presentation I've ever given to shareholders, there's been one constant theme: show me the cash flow. Let me tell you something that will fundamentally change how you think about investing. A stock is not a lottery ticket. It's not a piece of paper you trade hoping someone else will pay you more for it tomorrow. A stock is ownership in a business. And when you own a business, there's only one question that matters: how much cash does this business generate, and how much of that cash comes back to me as the owner? This is why I love dividend stocks. Not because dividends are sexy or exciting. They're not. Dividend investing is boring, it's predictable, it's methodical, and that's exactly why it works. While everyone else is chasing the next Amazon or the next Tesla, hoping to get rich on capital appreciation, dividend investors are collecting checks, real money, cash hitting their accounts every quarter. And over time, those checks compound into extraordinary wealth. Let me break down the mathematics of why dividends are responsible for the majority of stock market returns. This isn't my opinion. This is historical fact. Since 1926, dividends have accounted for approximately 40% of the total return of the S&P 500. But here's where it gets interesting. When you factor in the reinvestment of those dividends and the power of compounding, dividends are responsible for roughly 70 to 80% of total returns over long periods. Think about that for a second. 80% of your returns don't come from the stock price going up. They come from the dividends you receive and reinvest. This is the power of compound interest that Albert Einstein allegedly called the most powerful force in the universe. And yet most investors completely ignore it. They focus obsessively on stock prices, checking their portfolios daily, panicking when prices drop, celebrating when prices rise. Meanwhile, the real wealth is being built quietly through dividend payments and reinvestment. Let me give you a concrete example. Let's say you invested $10,000 in the S&P 500 in 1970. If you only captured the price appreciation and never reinvested dividends, your investment would be worth around $190,000 today. Not bad. But if you reinvested those dividends, your investment would be worth over $1.6 million. Same stocks, same time period. The only difference is reinvesting dividends. That's an 8 times difference in total wealth. This is why I structure my personal portfolio around dividend-paying stocks, not growth stocks that pay nothing and promise everything, not speculative plays that might 10x or might go to zero. Boring, stable, cash-generating businesses that pay me for the privilege of owning them. Now, let me address the counter-argument, because I know what the growth stock advocates are thinking. They say, Bill, why do you want companies to pay dividends? That money is taxed. Wouldn't it be better if the company reinvested that cash to grow the business? It's a fair question. And the answer depends entirely on the quality of the management team and the opportunities available to the business. If a company can reinvest capital at high rates of return, absolutely they should. Amazon didn't pay a dividend for decades because Jeff Bezos could deploy every dollar of cash flow back into the business and generate extraordinary returns. That makes sense. But here's the reality. Most companies cannot reinvest capital at high rates of return. Most businesses mature. Growth slows. Markets saturate. And when that happens, Management faces a choice: return cash to shareholders through dividends and buybacks, or waste it on empire-building acquisitions and vanity projects. I've seen this pattern hundreds of times. A successful company generates massive cash flow. Management feels pressure to deploy that cash, so they overpay for acquisitions. They enter markets they don't understand. They build new headquarters, buildings, and corporate jets. They destroy shareholder value in the name of growth. This is why I love dividends. A dividend is a discipline mechanism. It forces management to give cash back to shareholders instead of wasting it. When I analyze a potential investment, one of the first things I look at is the dividend policy. Not because I need the income, but because it tells me how management thinks about capital allocation. A company that pays a consistent, growing dividend is telling me several things. First, they generate reliable cash flow. You can't fake a dividend. The cash has to be there. Second, management is confident in the future. You don't commit to paying dividends if you think the business is in trouble. Third, they're shareholder friendly. They understand that their job is to generate returns for owners, not build empires. Let me talk about the types of companies I target for dividend investing. I'm not interested in high-yield dividend traps. You know the ones. Companies yielding 8, 10, 12%. Those high yields are usually a warning sign. The market is telling you something's wrong. The dividend is about to be cut. The business is in trouble. I've seen too many investors chase yield only to watch the dividend disappear and the stock price collapse. What I look for are dividend aristocrats. These are companies that have not just paid dividends, but increased their dividends every single year for at least 25 consecutive years. Think about what that means. These companies survived the dot-com crash. They survived the 2008 financial crisis. They survived the pandemic. Through recessions, market crashes, and economic chaos, they not only paid dividends but increased them. That's durability. That's quality. Companies like Johnson & Johnson, which has increased its dividend for over 60 consecutive years, Procter & Gamble, over 65 years, Coca-Cola, over 60 years. These aren't exciting technology disruptors. They're boring consumer staples, companies that sell toothpaste and soap and beverages. And they've made their shareholders incredibly wealthy through the power of compounding dividends. Let me explain my framework for evaluating dividend stocks. I use 5 criteria, and a company needs to meet all 5 before I'll consider it for investment. First, sustainable payout ratio. The payout ratio is the percentage of earnings paid out as dividends. If a company earns $4 per share and pays $2 in dividends, the payout ratio is 50%. I want to see payout ratios between 40 and 70%. Low enough that the dividend is safe even if earnings decline temporarily. High enough that shareholders are actually benefiting from the cash flow. If the payout ratio is too low, management is hoarding cash. If it's too high, the dividend is at risk. Second, consistent dividend growth. I don't just want a company that pays dividends. I want a company that increases dividends every year. This tells me the business is growing. Cash flow is expanding. Management is committed to returning increasing amounts of capital to shareholders. I look for companies with at least 10 years of consecutive dividend increases, and preferably much longer. Third, strong competitive moats. This is classic Warren Buffett thinking, and it applies perfectly to dividend investing. A company needs durable competitive advantages to generate the consistent cash flow required for reliable dividends. That could be brand power like Coca-Cola, network effects like Visa or MasterCard, regulatory barriers like utilities, high switching costs like enterprise software. Whatever the moat is, it needs to be real and sustainable. Fourth, reasonable valuation. I don't care how great a company is. If I overpay, my returns will suffer. I use a combination of metrics to assess valuation, price to earnings ratio, price to free cash flow, dividend yield relative to historical averages, enterprise value to EBITDA. I want to buy quality companies at reasonable prices, not pay premium prices for quality companies. Fifth, shareholder-friendly management. This is harder to quantify but critically important. I want management teams that think like owners, who have significant personal stakes in the business, who prioritize capital allocation over empire building, who communicate clearly with shareholders, who make rational decisions about dividends and buybacks. The best way to assess this is to study the track record. How has management allocated capital historically? Have they made smart acquisitions or destroyed value? Do they pay themselves reasonably or excessively? Do they return cash to shareholders or hoard it? Let me give you some specific examples of dividend stocks I've owned or currently own. I'm not giving you investment advice, but I'll tell you my thinking on these positions. I've owned shares in Restaurant Brands International, which owns Burger King, Tim Hortons, and Popeyes. This is a classic dividend play. Stable cash flows from franchise royalties, predictable consumer demand, a business model that scales without massive capital investment. They pay a healthy dividend and have the cash flow to support it. The restaurant business isn't going anywhere. People will always need to eat. And these brands have decades of operating history proving their durability. I've invested heavily in Lowe's, the home improvement retailer. Again, stable business model. Recurring revenue from homeowners who need to maintain and improve their properties. Strong competitive position against Home Depot in a essentially duopoly market. Excellent cash flow generation. And management that has consistently returned cash to shareholders through dividends and buybacks. This is a boring business that compounds wealth steadily over time. Canadian Pacific Railway is another position I've held. Railroads are incredible businesses for dividend investors. They own irreplaceable infrastructure. You cannot build a competing railroad network in North America. The barriers to entry are insurmountable. They have pricing power because shipping goods by rail is often the only economic option. They generate massive free cash flow because once the infrastructure is built, the incremental cost of running trains is relatively low, and they pay dividends funded by that cash flow. These aren't glamorous investments. Nobody's talking about railroad stocks at cocktail parties, but that's exactly the point. While everyone else is chasing the next hot IPO or cryptocurrency or whatever nonsense is trending on social media, I'm collecting dividend checks from boring businesses with durable competitive advantages. And those dividend checks compound into extraordinary wealth over time. Now let me address portfolio construction, because owning individual dividend stocks is only part of the equation. How you structure your portfolio determines your risk and return characteristics. I believe in concentration, not diversification. This is controversial, I know. The traditional advice is to own hundreds of stocks to diversify away risk. I think that's nonsense. If you own hundreds of stocks, you're guaranteeing mediocre returns. You cannot possibly understand hundreds of businesses well enough to make informed investment decisions. What you end up with is a closet index fund with higher fees. My approach is to own 20 to 30 stocks maximum. Each position represents a high conviction bet on a business I understand deeply. I've read the financial statements. I've analyzed the competitive dynamics. I've met with management. I've stress tested the business model under various economic scenarios. And I've concluded that this business will generate reliable cash flow and growing dividends for decades. This concentration creates volatility. My portfolio will fluctuate more than a diversified index fund. But I don't care about short-term volatility. I care about long-term returns. And the long-term returns from owning a concentrated portfolio of high-quality dividend stocks crush the returns from broad diversification. I also balance dividend stocks with some growth positions. I'm not a religious zealot about this. Dividends should be the core of your portfolio, but there's room for high-quality growth companies that reinvest capital effectively. I've owned positions in companies like Starbucks, Chipotle, and other growth-oriented businesses. The key is that these companies have clear paths to profitability and cash flow generation, even if they're not paying dividends today. Let me talk about dividend reinvestment because this is where the real magic happens. When you receive a dividend payment, you have two options. Take the cash and spend it, or reinvest it by buying more shares. In the accumulation phase of your investment career, you should always reinvest. Here's why. Let's say you own 100 shares of a stock trading at $100 per share. Your total investment is $10,000. The stock pays a 4% dividend, so you receive $400 annually. If you reinvest that $400, you can buy 4 more shares. Now you own 104 shares. The next year, the company increases its dividend by 5%. Now you're receiving $420 on your 104 shares. Reinvest that, buy more shares. The year after, the dividend increases again. You buy more shares. This is geometric growth. Your dividend income is growing because the company is increasing its dividend. And your dividend income is growing because you own more shares through reinvestment. These two forces compound together to create exponential wealth. Over a 30-year investment horizon, reinvesting dividends can turn a $100,000 investment into well over $2 million with quality dividend stocks. The same investment without reinvestment might only grow to $600,000. That's the power of compounding, and it requires no effort beyond clicking the reinvest button. Let me address taxes, because dividend taxation is a common objection to this strategy. In the United States, qualified dividends are taxed at long-term capital gains rates, which for most investors is 15%. That's lower than ordinary income tax rates. And if you hold dividend stocks in tax-advantaged accounts like IRAs or 401ks, you can defer or eliminate taxes entirely. Yes, you pay taxes on dividends in taxable accounts, but you also pay taxes on capital gains when you sell appreciated stocks. There's no avoiding taxes on investment gains. The question is whether you'd rather have reliable cash flow through dividends or speculative appreciation through stock price increases. I'll take the cash flow every time. Another benefit of dividend investing that's often overlooked is behavioral. Dividends create positive reinforcement. Every quarter, you receive cash. You see real money hitting your account. This reinforces the habit of long-term investing. It makes it easier to hold through market volatility because you're getting paid to wait. Contrast that with owning non-dividend paying growth stocks. Your only feedback is the stock price. When the price is up, you feel great. When it's down, you feel terrible. This emotional roller coaster leads to bad decisions. People sell at the bottom and buy at the top because they're reacting emotionally to price movements. Dividend investors don't have this problem. The dividend keeps coming regardless of the stock price, so you can ignore the noise and stay focused on long-term compounding. Let me share some statistics that demonstrate the power of dividend investing. From 1972 through 2022, dividend-paying stocks in the S&P 500 returned an average of 9.6% annually. Non-dividend-paying stocks returned just 2.3% annually. That's over a 4 times difference in annual returns. Compounded over 50 years, that gap becomes absolutely enormous. Additionally, companies that pay dividends tend to be more financially stable. During market crashes, dividend-paying stocks typically fall less than non-dividend payers. During the 2008 financial crisis, dividend-paying stocks in the S&P 500 fell 31% on average. Non-dividend payers fell 43%. That's significant downside protection. And during recoveries, Dividend stocks participate fully in the upside while providing income along the way. This combination of downside protection, reliable income, and upside participation makes dividend investing the most rational strategy for long-term wealth building, in my opinion. Now, let me discuss some common mistakes dividend investors make so you can avoid them. Mistake number 1, chasing high yields. I see this constantly. Investors screen for stocks with the highest dividend yields and blindly buy them. This is incredibly dangerous. High yields are often a trap. The market is telling you the dividend is unsustainable. The stock price has fallen because investors expect a dividend cut. And when that cut comes, you lose both the income and the capital as the stock price collapses further. I learned this lesson early in my career, investing in what I thought were high-quality, high-yield stocks. Some worked out. Many didn't. The dividend got cut. I lost money, and I realized that chasing yield is speculation, not investing. Now I focus on dividend growth and sustainability, not absolute yield. Mistake number 2, ignoring valuation. A great company at a terrible price is a terrible investment. I don't care if it's Johnson & Johnson or Coca-Cola or the best business in the world. If you overpay, your returns will suffer. You need to buy quality companies at reasonable valuations. This requires patience. It means waiting for market corrections or company-specific issues that temporarily depress the stock price. But that patience is rewarded with superior long-term returns. Mistake number 3, lack of diversification across sectors. Even though I advocate for concentration in individual stocks, you still need diversification across sectors. If all your dividend stocks are in the energy sector or financial sector, you're exposed to sector-specific risks. I spread my dividend holdings across consumer staples, healthcare, financials, industrials, technology, and other sectors. This ensures that sector downturns don't destroy my entire portfolio. Mistake number 4, not monitoring the dividend. Just because a company has paid dividends for decades doesn't mean they'll continue forever. You need to monitor the financial health of your holdings. Watch the payout ratio. Track earnings and cash flow. Read quarterly reports. If you see signs of trouble, deteriorating fundamentals, shrinking margins, declining cash flow, you need to act. Either sell the position or reduce it. Don't blindly hold a stock just because it's been a good dividend payer historically. Mistake number 5, emotional decision making. The market will crash. Your dividend stocks will decline in value. This is inevitable. The question is how you respond. The wrong response is panic selling. The right response is staying calm, collecting your dividends, and potentially buying more shares at lower prices. Every market crash in history has been temporary. Every single one has been followed by recovery and new highs. If you sell in panic, you lock in losses and miss the recovery. If you stay disciplined, you compound wealth through the cycle. Let me tell you about my experience during the 2008 financial crisis because it illustrates these principles perfectly. In 2007, I had significant positions in dividend-paying financial stocks, banks, insurance companies, real estate investment trusts. These were high-quality companies with long dividend histories. Then the crisis hit. The stock prices of my holdings got destroyed. Some fell 50, 60, 70%. Many investors panicked, sold. They got out of financials completely. They swore they'd never invest in banks again. I took a different approach. I analyzed each holding individually. Some were genuinely in trouble and I sold them, but others were fundamentally sound businesses facing temporary liquidity issues and market panic. Those I held, and in some cases, I bought more. The banks I held, companies like Wells Fargo and U.S. Bancorp cut their dividends temporarily. That was painful. But they survived. They recapitalized, and within a few years, they restored and grew their dividends. The stock prices recovered and then some. Investors who sold in panic locked in massive losses. I rode through the storm, collected reduced but still positive dividends, and came out far ahead. This experience reinforced my belief in dividend investing. Quality companies with durable business models survive crises. They might stumble temporarily. Dividends might get cut, but if the core business is sound, they recover. And patient investors who hold through the volatility get rewarded. Let me discuss the role of dividend stocks in different life stages, because the strategy should evolve as you age. In your 20s, 30s, and 40s, the accumulation phase, dividend stocks should be a core holding, but not your entire portfolio. You have decades to compound wealth. You can take more risk. So maybe 60% dividend stocks, 40% growth stocks. Reinvest all dividends. Don't spend any of the income. Let compounding do its work. In your 50s and early 60s, the transition phase, you shift more heavily into dividends. Maybe 75% dividend stocks, 25% growth. You're getting closer to retirement. Capital preservation becomes more important than aggressive growth. But you still reinvest dividends because you're not living off the income yet. In your mid-60s and beyond, the income phase, dividend stocks should dominate your portfolio. Maybe 85 to 90% dividend stocks, with the remainder in bonds or cash for liquidity. Now you stop reinvesting dividends and start living off the income. This is what you've been building toward for decades. A portfolio that generates enough dividend income to fund your lifestyle without selling shares. The beauty of this approach is that you never have to sell your stocks. You're living off the cash flow. Your principal remains intact. And if the dividends keep growing, your income keeps growing even in retirement. This provides inflation protection and ensures you don't outlive your money. Let me address the psychological aspects of dividend investing because mindset is just as important as strategy. Dividend investing requires patience. It's not exciting. You're not going to double your money in 6 months. You're not going to get rich quick. This is a slow, methodical process of compounding wealth over decades. Our culture celebrates quick wins. We idolize people who made millions trading cryptocurrencies or meme stocks. We ignore the boring millionaires who built wealth slowly through dividend investing. This creates a psychological hurdle. Dividend investing feels too slow, too boring, too unsexy. You have to overcome that. You have to internalize that slow and steady wins the race, that boring is beautiful, that the path to real, sustainable, generational wealth is through compounding, not speculation. Once you accept this, dividend investing becomes easy. You stop checking stock prices daily. You stop worrying about market fluctuations. You just collect your dividends and reinvest them. Another psychological challenge is FOMO, fear of missing out. You'll watch growth stocks double or triple while your dividend stocks grind higher slowly. You'll be tempted to chase the hot stocks. You'll think you're missing out on easy money. This is where discipline matters. Remind yourself why you're a dividend investor. You're building sustainable wealth. You're generating cash flow. You're sleeping well at night knowing your capital is protected. The growth stock chasers might have a great year or two, but eventually they'll crash. They'll lose 50% in a bear market. They'll panic and sell at the bottom. Meanwhile, you'll still be collecting dividend checks. And over decades, your boring, disciplined approach will create far more wealth than their speculation ever could. Let me share my final thoughts on why dividend investing is the most powerful wealth-building strategy for individual investors. It combines the best elements of stock investing, business ownership, and income generation. Unlike bonds, dividend stocks provide inflation protection through dividend growth. Unlike growth stocks, dividend stocks provide income and downside protection through cash flow. Unlike real estate, dividend stocks provide liquidity and ease of management. Unlike starting a business, dividend stocks require no operational involvement. You own pieces of the best businesses in the world, they send you checks, and you compound wealth passively. The mathematics are undeniable. 70 to 80% of stock market returns come from dividends and reinvestment. Companies that pay and grow dividends outperform non-dividend payers by massive margins over time. Dividend aristocrats, companies with 25 plus years of consecutive dividend increases, have crushed the broader market indices consistently. The behavioral advantages are equally powerful. Dividends create positive reinforcement, making it easier to invest consistently and hold through volatility. They provide income that can be reinvested or spent, giving you flexibility. They force you to focus on cash flow and fundamentals rather than speculation and price momentum. And the strategic benefits are compelling. Dividends indicate financial strength, shareholder-friendly management, and business maturity. They provide a margin of safety because you're getting paid to hold regardless of stock price movements. They allow you to build a portfolio that generates increasing income over time, providing financial security and independence. This is why I've structured my personal wealth around dividend-paying stocks. This is why I advocate for this strategy to individual investors. And this is why I believe dividend investing is the most rational, sustainable, and profitable approach to building long-term wealth in the stock market. It's not exciting. It's not flashy, but it works. And in investing, working is all that matters.